Good morning, everybody. Welcome to the DHL Express webinar this morning as we discuss the GST changes coming into effect for New Zealand in December this year. My name is Michael Reid. I'll be your webinar host for today. Just before we get started, a quick note. All the information provided in today's webinar is exactly that, alone information for your information. And if you require any further regulation or compliance, we suggest seeking legal counsel to understand that further. So joining me today, I have special guest Megan Ellis from the New Zealand High Commission and customs expert Ben Somerville from DHL Express. So together, we will explain the specific changes coming into effect, the businesses that they apply to, the benefits of those, and how you go about registering. Firstly, to Megan. Megan is the Customs and Immigration Counsellor at the New Zealand High Commission in Canberra. She represents both New Zealand Customs Services, Immigration New Zealand, both government agencies and industry partners around Australia. She regularly meets with officials, industry representatives to resolve issue progress initiatives which help secure the borders of New Zealand and Australia. So welcome, Megan.
Thanks.
Ben is responsible for developing and executing the corporate regulation and customs strategy for DHL Express operations in Australia. He is also a member of the Executive Committee to the Board of Directors for the Conference for Asia Pacific Express Carriers. With 25 years experience, a licensed customs broker, Ben, welcome as well.
Thanks, Michael.
So many of you on the call will no doubt be aware of the changes which came into effect in July last year for low-value goods entering into Australia. So perhaps, Ben, to set the scene, if you can give us an insight into what that process was and how it's been operating so far.
Sure. Thanks, Mike. And hello all. Just before we go through the changes that are taking place in New Zealand, I thought it might be worthwhile just to give a very quick snapshot of the Australian example, in particular what has been driving these changes. So essentially back in 2012, a particularly prominent, whose name I won't mention, but a particularly prominent Australian retailer made some comments about retailers being punished by the surge in B2C, business to consumer, online e-commerce. Which was a very well-made point in the sense that they were having to pay GST on goods that they would be importing, but the low-value goods were coming in GST-free. So there was the issue of the anti-competition for local retailers, as well as the government saw an obvious hole in revenue of GST that they weren't getting for those low-value goods. So there was a productivity commission review, there was a low-value parcel processing task force, and a range of other steering committees and working groups over a period of about 6 to 7 years, where they looked at how they could actually collect the GST efficiently. So everyone was in furious agreement that there was a GST leakage. It was just working out an efficient and effective way to collect that GST. So a number of things. One of the big issues for DHL and our competitors was if it was collected at the border, then that would cause a lot of congestion and a lot of delay to customers receiving their parcels. So fast forward to 1 July last year, which was when the Australian model kicked in and became live, and that was based on a vendor collect model, which is essentially, we'll talk through it, but it's essentially when the GST is collected at the point of sale. So Australia was, true to say, the guinea pig in all of this. It was the first country to go live with this type of model. New Zealand, as we'll hear, are about to follow suit, and there's a number of other countries, Norway, Singapore, the UK are looking at it. So there are other countries effectively queuing up to follow suit because it has been effective. But I just thought that might be useful in a nutshell to explain the Australian context and what is driving these changes.
Thanks, Ben. So Megan, if you could just give us a rundown of what is actually going to be, what the law changes mean and what that stipulates.
Of course. Good morning, everyone. So in June of this year, the New Zealand government passed some new legislation which changes how GST is applied to goods imported into New Zealand. So from 1st of December this year, overseas businesses that sell low-value goods to consumers in New Zealand will need to register for, collect and then return GST under these new rules. So when certain conditions are satisfied, merchants, operators of electronic marketplaces and redeliverers will be required to register for, collect and return GST on goods supplied to consumers in New Zealand. So the new legislation is called the GST Offshore Supplier Registration Act, and that was passed in the New Zealand Parliament on the 26th of June 2019. And so from the 1st of December of this year, overseas businesses, online marketplaces and deliverers that sell to consumers in New Zealand may need to take the following actions if they are sending low-value goods that exceed 60,000 New Zealand dollars over a 12-month period. So first, they will need to register with the Inland Revenue Department of New Zealand for a GST registration number, and then they will need to collect and return GST of 15%. So low-value goods are classed as those physical goods which are valued at 1,000 New Zealand dollars or less. That 1,000 New Zealand dollar threshold is based on the customs value of the good, and so excludes any insurance or freight costs. If the low-value goods are valued above that threshold, GST needs to be charged and collected on exports to New Zealand. The legislation also lists the threshold on a range of duties, tariffs and fees that currently apply to goods between the value of 400 and 1,000 New Zealand dollars. IRD in New Zealand will have the responsibility for collecting GST on goods valued below 1,000 New Zealand dollars, and the New Zealand Customs Service collects GST on those goods valued over 1,000 New Zealand dollars. So what is a low-value good? So it's any physical good that is valued at 1,000 New Zealand dollars or less, excluding GST. So some examples could include books, cosmetics, clothing, shoes, sporting equipment, or any small electronic item. So New Zealand has a single rate of GST at 15%, and that applies to almost all goods supplied in New Zealand. These changes in this legislation do not apply to alcohol and tobacco products or to fine metal. Those are the only exceptions. And this is because GST is collected at the border by New Zealand Customs Service on alcohol and tobacco already, regardless of the value of these items. Businesses sales are also exempt, so low-value goods sold to GST-registered businesses in New Zealand for use in their businesses are also generally excluded under these new rules. But if a New Zealand business imports goods in a consignment valued over 1,000 New Zealand dollars, the business will pay GST and duty on these goods at the border. Michael.
Thank you, Megan. So some good insight there. So perhaps to summarise, Ben, who does, who doesn't need to register for the scheme, can you just take us through a bit of a snapshot of what that looks like exactly?
Sure, Mike, thanks. Yeah, so basically, just to summarise what Megan said there, we've got if you've got a turnover of that key turnover amount of sales, annual sales of 60,000 New Zealand dollars, if the turnover is over that and you fall into one of those categories, so the merchants, the marketplaces or the redeliverers. Redeliverers is a term too that you will see, and that's essentially a consolidation house where low-value orders are consolidated and sent. So if you fall into one of those categories, you're selling to private individuals, and that's a key point as well that people need to be aware of. If it's a business to business, then they are not in scope for these changes. But if it is business to consumers, so those private individuals, if that comes into play, you're selling goods that are $1,000 or less, excluding alcohol, tobacco, fine metals, then you will need to register with the IRD, and we'll explain how in a moment, that you'll actually need to register for that number and to collect GST at the point of sale. So we'll go through that, and you can see there that if your threshold is less than $60,000, or you're selling goods that are over that $1,000. If you're selling goods over $1,000, it's business as usual, and that will continue to be formally entered with duties and formal entry fees and GST collected by New Zealand Customs at the border. These changes only kick in when those requirements take place. And the last point there to reiterate is that B2B are exempt. That's probably just a handy slide in that you want to just, if you want to put your business up against that to see whether or not these changes apply to you.
No problems. And then we go on to the next slide here. We'll kind of just isolate that out again. So above, below $1,000. Ben, perhaps we can talk here at this stage to a retailer who might be sending above and below $1,000. Yeah, sure. Thanks, Mike. Yeah, this is an interesting change in that you can see if you're selling goods that are below $1,000, then there's no duty on those goods. There will be GST, and that's from 0 to 1,000. There will be GST coming in.
If you're registered under this scheme, you'll be collecting that, as we've mentioned, at the point of sale. Won't be at the border, and that really is a key point. It won't be stopped at the border. So if you're, you won't have to stop and collect $5, $10 at the border, because the congestion that would cause with the volumes of air cargo coming into New Zealand are such that that would be prohibitive on both on service providers such as DHL, as well as the Customs Administration and MPI and so on. But there also will not be the formal entry fee of the $55.71, the New Zealand dollars, because there's no formal entry on goods because they're under the $1,000. For goods over $1,000, I think one important point to make would be if you are hearing this and you're saying to yourself, okay, I need to register, but you sell goods that are both under $1,000 and over $1,000, then you may be thinking, well, why can't can I possibly just collect GST at the point of sale for all of those goods? That is allowable under certain circumstances, which the IRD have got some good information on their website for. But it is very important that the goods that are over $1,000, that it's clearly stipulated that you've collected the GST at the point of sale. Mm-hmm. Failure to do that could result in what's known as double taxation. So you've got your consumer, the purchaser of the goods, but paying GST to you at the checkout, and also being paid at the border when the goods are entered on a formal entry. I'll explain that in a little bit more detail later, but that is a really key point, that it's important you get that piece right. If you're selling goods that are under $1,000 and they're always under $200, $300, $400, that's not an issue. But if you're around about, if your checkout in some of your orders goes over that $1,000 New Zealand dollars, that's when this comes into play, and you need to just understand how that works.
Sure. Okay. And we spoke earlier a vendor collect model, which is a similar model to what was brought into effect in Australia. So how does that look and operate from a DHL perspective as well as customs?
Yeah. Okay. So look, sadly, this has been a big part of my working life for the last few years with the Australian model. So the slide that you can see up on the screen now just really tries to put in a very simple flow. I've found that a lot of people can overcomplicate this. In essence, it is a fairly simple model, albeit the changes people need to get their heads around. But if you can look at the first, the shop front there, the red seller of the goods, just immediately to the right-hand side of that, they need to have that relationship with the IRD. So if they meet the criteria that we've gone through, they will need to register for their IRD GST number, and they will need to start collecting the GST at the point of sale on those goods and remitting that to the IRD. How that works, again, there's some excellent information on the IRD website, but it's essentially done on a quarterly basis. After it comes in from 1 December, there'll be the first 4 months, and thereafter it's on a quarterly basis that they remit that GST collected. If you look at that shop front and then go to the left-hand side, that's when DHL comes into play in terms of the role that we play in this process. So we don't collect the tax, that's done by the registered vendor at the point of sale. But what we do require, which we need to pass through, is the shipper's registered number, so that IRD GST number. We need to be able to capture that, and we would capture that along with the information that we would normally do with a consignment. So information that you would give normally with the receiver's name and address, the goods description, value, and so on. All of those fields remain the same with the addition of this number. We then, as you can see, the flows around to the left, you would provide that to DHL. We would then capture that, send that on to New Zealand Customs, and New Zealand Customs would pass that through to IRD. A question that I'm often asked is, well, why did DHL even need to do that part of the process? If it's between the vendor and IRD, why can't they just collect tax and remit? Well, what this does is this allows the IRD to actually, it assists in reconciling exactly what's coming into the country with what tax is being paid. So it is important that both flows exist, and the important point to note is that DHL can actually capture that registration number and pass that through to the IRD in accordance with these legislative requirements.
Sure. So if we talk the DHL role within that, so we've got to capture the number from the retailer and provide that to customs. Mm-hmm. So how's that process going to operate from a commercial invoice perspective? What's required there?
Yep. Okay. Thanks, Mike. So really what it is it's just that additional field, that additional number, which I understand is 8 digits. So that number will be captured into a designated field in the DHL system. We then pass that through to New Zealand Customs, and then they in turn pass that to the IOD. The slide that you can see now, the important piece to note here is on the commercial invoice that if GST is collected at the point of sale, that is stated on the commercial invoice. The reason for that is really to take out any ambiguity for the clearing part of the process that the GST has possibly not been collected. If it's clearly stated, the two pieces of information, it's not prescribed in the legislation per se, but it is very important and good business practice for those documents to have the registration number and the fact that GST has been paid. It, as I said, it just takes out any doubt, and it can be clearly treated and cleared across the border in New Zealand accordingly. Probably the next slide, if we go to the next slide, I can explain how we collect that. DHL Express has a suite of e-commerce systems in how we capture our customers' shipment data. So that can be done from EasyShip, My DHL Plus, a number of applications. The one you can see on your screen now is My DHL Plus, and you can see there that there's a designated field where that number is input. So it's very important that where GST is collected, that registration number is communicated to us in exactly the same way as what the goods are and how many pieces and the weight and what they're worth. That then goes into that field and is passed through. So there's really, the point to make there is that whatever DHL system you're using, could even be an integrated customer with a sophisticated back-end integration, the same goes there as well. We've got a field that can capture that registration number and pass that through. Yep.
So this is a really important operational piece to get right to avoid challenger issues, certainly at the border. So I think to all on the call who do have a DHL Express account manager, certainly my message would be get in touch with them, understand what your shipping solution is, whether it's a My DHL Plus, an EasyShip, or an integrated solution, and speak to them about how we best transmit that for your solution to make sure that there's no hold-ups or issues with compliance from a legal perspective in New Zealand, I think. Yeah. If we move on, so obviously this change can be seen in a couple of lights, whether it's a positive or how it's best perceived from both you and then also your customers. So we thought at this stage, let's go through 2 or 3 live examples of possible situations which could arise for you and how that change is going to then impact that. So the first one we looked there, a sale of a t-shirt of $50 New Zealand going into New Zealand. Currently, when it reaches the border, there's no collection of any duty, tax or anything else. Clears through customs, goes straight to your end customer. The change in this situation that will come into place under the new scheme is that customer's order will now cost the $50 plus the 15% GST, meaning a cost of $57.50 to the customer. However, that $7.50 is known to them at the point of checkout, so there's still no hidden cost as far as what that customer is getting themselves into. I think where the big change comes is around the next 2 examples where you've got a $300 and a $600 example. So currently, you sell a $300 item, a jacket, let's say, to New Zealand. You've got the cost of the goods, and then there's a further $132 worth of costs that incur when those goods arrive into New Zealand. You've got the cost of the duty, you've got a cost of GST, and then there's a processing fee with New Zealand Customs. Currently, that $132 is either an impact to you and your business and your margin, or it's passed off to your customer, leaving a probably somewhat negative experience on their impression of having bought those goods. So the change that will come into effect, that $300 item will now be $300 plus the GST of 15%, a purchase price of $345 to the customer. And again, that $45 is known to them upfront at the point of sale. So as far as goods arriving into New Zealand, clearing customs, being passed on to them, there's no hidden cost in this area where there previously or currently is today. And then the same example happens for the $600 phone, an item which is duty-free into New Zealand, but still incurs a 15% GST and a processing fee. So, again, an additional cost of $140 that's potentially unknown to either you, the retailer, or B, you, your customer, that is incurred by one or the other. Moving into December onwards, that's a $690 purchase with the cost known upfront of the GST again collected at the point of sale. So the real positive, and again, I'd stress at this point, one, get compliant with what needs to be done from a legal and a technical perspective, have a conversation with the account manager and understand how you best position this as a value add to drive more sale transactions into New Zealand as an opportunity for you as well. In terms of registration in that process, so registration is now currently live, so you can register already. And we do suggest, we will be sharing the slide deck with all of you at the end of the presentation anyway, but the IRD website is where you go to complete that registration. So we've got about 6 weeks or so before that's live, so it's just going out there and starting that process now. And if you do have questions, you have the ability to have support from the IRD website to do that. So the website itself has a lot of information that is going to be really useful as far as additional support. They've created a great little 11-minute video which you can use, again, to give you a snapshot of some of the things we've discussed today. And I think that the IRD has been really progressive in trying to give as much information, as much support, and we would certainly stress that this is probably certainly the best place to go for finding that information and additional support.
And just on that point too, Mike, with the IRD, DHL Express in New Zealand are obviously very well across this issue and are dealing regularly with IRD. So at both sides of the Tasman, we're well equipped, we're well across the changes and what's required to make it as seamless as possible for you.
Sure. Cool. So look, in terms of the formal detail, that's a lot of being covered up until now. So I think in terms of making sure this is as collaborative as possible, we'll certainly open the floor to any questions that you may have. I think we've got some come through already. So we'll start with an informal Q&A around any of the topics that we have discussed or anything that you may be unsure of as well. Okay, so Ben, a question from David. So sales into New Zealand businesses, irrespective of the value, have not been covered by this change. So sales going to a New Zealand business, where there's a New Zealand business that you're selling to, they don't fall under the scheme, is that correct?
Yeah, correct. So the B2B or business to business. So if you're a shipper in Australia, you're selling to a registered business in New Zealand, that's deemed to be a B2B transaction, and that's out of scope for the purposes of this scheme now. I think a lot of people, I'm assuming, that are on this webcast are Australian shippers. So there would be other shippers around the world, a lot of out of the US and out of Europe, Asia, that have been shipping into Australia with the changes that that I've gone through. But I think it's very important that the Australian shippers understand these changes, because it's such a big, important trade lane. And there's a number of businesses that wouldn't have had to really look into this vendor collect model in the past. So, but yeah, to your point, B2B excluded.
Sure. Okay. And a follow-up for you, Ben, as well, from Stacey. What are the consequences of not collecting the GST at the point of sale when your sales do go over the $60,000 a year threshold?
Okay, so if you meet that criteria, I suppose this is to a broader compliance point. The IRD have got some good information on their website around this, but essentially if you meet that criteria, then the legislation states that you need to register, collect GST and comply with that. A failure to do so could potentially lead to non-compliant action and what would be deemed to come from that. But really, it's all about just understanding the scheme, what you need to do to comply. I mean, if someone is over the threshold and should be registered and is collecting that GST, that's fine. If they're not, then the IRD may well be in correspondence with them at a later point in time. They do share information with other tax administrations around the world. It's an interesting area legally, which I won't profess to give any binding advice on, but suffice to say there's a lot of information between the tax administrations that are shared around the world, and they will do everything bilaterally that they can, or multilaterally that they can do to have people comply. So it's all about just having that tax neutrality, so that whether you're bringing in a high value shipment and paying GST on a bricks and mortar model, or a low value good on a B2C model, that everyone's paying their share of GST.
And a question from Christian for Megan. The $1,000 threshold, is that a per item in a consignment, or is that the overall consignment being sent to New Zealand?
So if there are multiple low-value goods in a single consignment that then is valued over $1,000, the supplier must collect GST on each of those items.
Okay. All right. Ben, another one from David. In the case you did not change a business GST, and I'm not sure if I can actually read that. Okay, so in the case that you did not claim and charge the GST at the point of sale, can you recover that by charging it at a later date?
So if you're registered...
If you're registered, but it wasn't collected at the point of sale, can it be collected at a later date?
That one would probably be best to contact the IRD to go through, because it's really case-by-case basis. Is it a one-off? Is it a systems issue in being registered perhaps, but not being able to have your checkout, having the ability to collect at point of sale? So that one I would suggest that David, just to contact the IRD and to go through that particular scenario. But with the point of sale too, and you made the point well before, Mike, is that from a consumer experience, so it takes out any concern or confusion at the border when the goods arrive, because if they don't want to pay the GST at point of sale, they don't make the sale, the goods don't move. So it's all done at that point. It takes out any confusion once it gets to the border. One point that we did that has come up in the past, in both the Australian and in this change as well, is that people have said, critics have said, well, if you bring this in, then B2C sales, e-commerce will go through the floor and people won't buy online anymore. Well, we personally, from my experience and from DHL's wider experience, we haven't seen that. If anything, if you've got good relationships with your customers, you've got a good product, good reputable product, and you clearly outline what that additional 15% is for, we haven't seen any decrease in our numbers either. So from a consumer perspective, as long as it's clearly stated what that's for, and really if they're paying 15% GST but saving 30, 40, upwards of 50% sometimes or more on locally procured goods, then that's when the competition comes into it. And from a consumer, that's a good thing for all parties, really.
Another one for Ben. What details does DHL pass to New Zealand Customs?
Okay, so we would report all of the information that we're currently reporting now, with the addition of that IRD GST number. So we pass that through. And as I mentioned before, the reason that we do that is to assist in the reconciliation of the tax that is remitted between the registrant and the IRD.
Okay. A question from Mark, perhaps to both of you. If you're not currently registered because you don't fall into the scheme, so you don't meet one of the thresholds, is the New Zealand customer likely to be inconvenienced by your experience or clearance or cost at the border?
No more than they would be under today's scenario.
Yeah.
So but if you're not subject to these new changes, then things will stay as they are now.
Okay. Yeah. So that's along the lines of the either formal entry or the processing fee, or the GST still being collected at the border as it is currently.
Correct. Yeah.
Okay. Another one. If you supply both B2C and B2B, do you count sales on both when calculating the $60,000 threshold? That's a good question.
I believe no, that you just count the sales to consumers in New Zealand. So just they're exempt from the scheme.
Okay. And again, for any further advice around that, we'd certainly stress going to the IRD website and directing any questions around that through to them specifically, I think, for that one.
Yeah, if you're close to that threshold, it's probably worth checking with IRD.
In terms of being close to that threshold, a question I've been asked, if you don't currently reach the threshold, but there's a perspective that somewhere in the next 6, 12, however many months you will reach that threshold, what's the suggestion there? Should they be registering now or waiting, or what's the best way to go about that?
I would suggest register now. It's a cost-free procedure anyway, and that means you'll set up to go should you be getting close to the threshold.
And it's quite a quick and efficient process to register as well on the link. One thing that I will give some kudos to the IRD actually is the website has got some excellent information that you alluded to there's the video, but the fact sheets are written in such a way that are very easy to understand. And I'd encourage anyone that's looking into this and feels they may be in that category just to have a look at the links that will be provided.
Yeah. And on that, we're getting a lot of questions come through around the actual registration process itself, in terms of what's required, what possible information, any further guidance or things we stress on in relation to that, or what is the onus on the retailer to do?
Yeah, there's the steps at which we'll be providing a copy of this, but yeah, you can see maybe Megan, if you...
Yes, so slide 15 of the deck gives you some details about what needs to be provided. It includes your name, your contact details, country of residence, any existing tax identification numbers that you may hold, a description of your business activity, and your website address. So it's reasonably straightforward and information you should already have to hand.
Fantastic. Thank you, Megan. Question from Mark for Megan. Can a registered New Zealand business that will sell to online be exempt by quoting the GST number?
So quoting the GST doesn't make you exempt, so it comes back to those thresholds and those criteria. If you meet the criteria, you need to collect the GST.
Kind of a similar question around that. I have a number of customers myself who they have a New Zealand website and they are selling from that New Zealand website to a New Zealand customer. And that New Zealand website has a supporting New Zealand business registered to it already. However, they ship the goods from Australia to the New Zealand customer.
Yep.
So in that instance, would they fall into the scheme or?
Potentially, again, if it's a threshold and if they're drawing on that stock in Australia that's going to consumers in New Zealand, then yes, potentially that would fall into scope. If they've got a number already, they don't need to re-register for a new registration number because they've got that already. It's just formalising this and capturing that group of low-value goods that wasn't previously in scope.
Okay, cool. We got any further questions? Is there anything else up until now that you think we've kind of missed or that we should further re-clarify before we...
I think one of the, again, in the Australian context, a lot of questions that came from that will probably be similar to much of this audience. It is straightforward. There's some excellent information on the IRD website, as I've mentioned. It's not a case of if a low value good comes in and it's not collected at point of sale, that all of a sudden it's stopped and comes to a screaming halt. That's not the case. It will flow through. But if you do meet that criteria, then we strongly encourage you to talk to the IRD to see if you fall into scope and comply accordingly.
Yep.
And really the over $1,000 shipments that exist now with the formal entry, the fees, the duties, the relationship that needs to be cleared across the border with customs and primary industries quarantine, that remains exactly as it does today.
Extending on from that, we spoke earlier a little bit about double taxation. Maybe we just clarify that a little bit more in terms of our interpretation of that and when that may or may not come into account.
Yeah, double taxation is a tricky one. It's certainly, from a consumer perspective, it's sin. You don't want a customer having to pay GST at point of sale only to receive another bill for GST from the driver that's delivering their parcel. So it's critical that that information is the GST paid, registration number is put on the invoice. A lot of the time, from what I've seen, is checkouts the number of items can increase such that it might just throw it over the $1,000, or a supplier may take the decision through ease of systems integration and the like to actually just collect GST on low-value goods or high-value goods, and that is allowable in certain circumstances. So if they do that, it's just important that they carve out those high-value shipments and make sure that it's very clear, because if a shipment comes in over $1,000, the process, as many would know, is that it would come in, it needs to have a formal entry done on it, and GST comes into play then. GST in New Zealand is more across the board and uniformly applied than it is in Australia. There's quite a few exemptions in Australia. In New Zealand, it's more of a simplified tax. It's 15% across the board. So that comes into play when there's a formal entry of a high-value good. And it is very important that if GST has been collected at point of sale, that you take out and mitigate that risk of applying the GST a second time. And the way that works is the customs broker would actually zero rate that shipment. they're legally able to claim an exemption based on the fact that it's been paid at point of sale. So it can work, but just double taxation is something that is certainly, and if it occurs, and if you set yourself up correctly, then it should not. But if it does occur, there's the scenario where the service provider such as DHL can't actually claim the refund. It then becomes a matter between the consumer and the vendor and IRD, and it becomes quite cumbersome and certainly not a good consumer experience. So it's really just getting that.
So if we get the shipping tool correct, we provide the information on the commercial invoice accurately, then we're avoiding the risk of that hanging around anyway. A question from Naomi. Can GST be collected and passed the ATO, I believe is the question.
To the ATO?
Yes.
For the purpose of this scheme, my understanding is no. That would be, it's purely an IRD.
It's a New Zealand government requirement, so it needs to be passed through to New Zealand government.
Yeah.
One coming from Mike. How will DHL handle a shipment from a shipper that is not registered due to falling under the $60,000 threshold and therefore not required to register? So I guess, again, in terms of what we do, is there anything that we will do differently to someone who's registered or unregistered because they're unregistered, don't need to register?
No, it would just go through. It wouldn't be, to my point before, it wouldn't be stopped at the border. It would just be. It's still, I guess the point to make on those shipments is that it's not just if it's a low value good and it's tax free that it just sails through. The manifest needs to be reported and risk assessed accordingly. So New Zealand Customs and NPI will run risk profiling over that, and even though there's the replications, there's certainly the risk assessment that's done at the border prior to clearance being given. But it won't be stopped for that $5 here, $10 there.
Yeah. We have a lot of customers who utilise both DHL Express and DHL e-commerce. Mm-hmm. In that model, does this apply for both e-commerce, DHL Express and DHL e-commerce customers?
Encourage whoever has
That's from Susan, sorry.
Okay, so I'd encourage Susan to check with the IRD, but my understanding is that once they've got a registration number, regardless of what business unit of DHL they're shipping through, the same would apply in terms of being able to have the one number, quote that in the appropriate field and pass that through. Yeah.
So I think, Susan, from an e-commerce perspective, definitely, again, reach out to DHL e-commerce, your account manager, and understand, similar to how we're suggesting a field to provide that GST number, that the same is done for e-commerce to ensure that compliance as well. What else have we got here? A question for Megan again. If we don't qualify for the $60,000 threshold, will our products get held by New Zealand Customs? I think around that would.
So no.
Yeah.
So if you're under the threshold and therefore exempt from the scheme, your goods will go through the same way they do now.
Yeah. Okay, fantastic. One from Linda. We have a sister company in New Zealand, but sometimes we will send goods direct to their customers. I guess the question, would that then fall part of the scheme? So if I understand, so they're selling they have a company that they partner or however with in New Zealand, and they're sometimes selling or sending goods direct to that company's customer rather than their own customer.
That would almost sound, sorry. Yeah.
I was going to say, you probably want to check that exact scenario with IR, but the basis of the scheme is around charging GST on the product. So if the New Zealand company is charging GST, then the Australian company does not need to. Yeah. But if the New Zealand company isn't, then the Australian company does.
So for simplicity, probably if you're the one that's incurring the transaction, so they're buying from you, you are responsible in that situation to collect the GST and file the GST. If it's somebody else's customer, you would, again, check with the IRD, but the likelihood they probably had collected the GST already in that transaction, perhaps.
Yeah, and the scenario that you allude to there, Mike, sounds to me like it's a bit of a mix between B2B and B2C. And there's nothing wrong with that, that's fine, but it's really just that B2C piece that is key for what we're talking about today.
Yeah. We have a number of customers, Ben, who utilise a break bulk model across to New Zealand to serve their B2C customers. Yep. So break bulk or BBX, for those who may understand, is that part of this scheme or are they exempt from this?
Again, it's really a case-by-case basis. There can be a situation where by deconsolidating and sending as low-value goods, that could be advantageous, and compliant and advantageous. But it's really, I'm loath to say across the board that it will be one way or the other without having a look at the specific commodity, the way that it's set up, because there are so many, as we all know, there's so many different business models now. It's not exporter A going to importer B anymore. There's so many other variances. So there's a degree of flexibility with which DHL can offer a range of services. But again, we've probably just said, let's understand your business model, and then around these changes, overlay these changes and see what works best.
Yeah. Okay. So probably again a question with the account manager to further understand that. Yeah. The nature of online retail now, we have a lot of marketplaces, Amazon and others out there. So if customers of ours are selling on a marketplace as well, are they to take the assumption that the marketplace is collecting the GST, or how will that look?
Yeah.
I would think it would be worth checking, for sure, and make sure that you're not the one being non-compliant.
Sure. And
any questions specifically around that scenario would be best posed in that revenue.
And inland revenue, to your point, Megan, they've got they define what those online marketplaces are, the merchants, the redeliverers. They've got good definitions around what meets those terms. Before the Australian vendor collect model came in, many of those marketplaces said that this can't be done, and they pushed back and said that we just can't collect, but it can actually work. And to the extent that it is exceeded all forecast revenue in the Australian context. So it can be done, and it does work, is the short answer. So one model that I've seen on eBay, which is quite useful, is they've got a one-line clause, if you like, around what GST has been collected and why, and that just helps from a consumer perspective. So I would recommend talking to the IRD, just understanding the definition of those marketplaces, because that even as a group, electronic marketplaces do have variances within them. So just understanding where that fits and what number and what needs to be captured and communicated.
Sure. Okay. Question from Greg. With goods not being sold in New Zealand dollars, what exchange rate would be used to determine the 1,000 New Zealand dollars threshold?
So there is a particular fact sheet on the IRD website around how the conversion of currency to New Zealand dollars.
Yep.
Obviously, that's a fluctuating rate.
So at any point in time, it would be the live rate on that website.
I believe so.
But
again, the daily rate that would generally be the same day. But yeah, they've thought of that very example with exchange rates, particularly around that border of $1,000. And there's some good information.
And I guess if you're teetering on that, again, that threshold of being passively above, below, then safety is certainly register and be compliant, if nothing else. Yeah. Sure. In the example of the $300 jacket, is one of the changes that no tariffs at the border processing fee will apply. So I think we're referring here to the $52 charge of processing that will be gone.
Yes, the entry fee, and that will most come into effect from the $0 to $1,000. This is really in the value range of $400 to $1,000. So it's those shipments there where there can be some savings in potentially duty and the entry fee. So it's streamlining it. It's paying the GST, but in some cases there will be other fees that will come off.
Sure. Okay. Question from Tan. Is the low value threshold now the same if you are on the scheme or not? Or is it 1,000 only if you are shippers on the vendor collect model?
No, it would apply to all.
Yeah. So you have the benefit of that increase to $1,000 threshold if you're still not yet at that level of $60,000.
Correct. That's a good question, actually. Yeah.
Question from Christine. We are an Australian business trying to get an IRD number, but the form states we need a New Zealand bank account or certification. If we do not have either of these, how would we register? Perhaps Megan.
Well, I'm afraid they'd have to talk to Inland Revenue about that in terms of what they can do. to get their registrations through.
Yeah. I guess to support us, or to support with that, again, we'll share this information and the links to the IRD websites, and certainly suggest that with those resources, that will be the first source to finding those answers for you as well.
And you will get support. I can speak from personal experience. You'll get support because from an IRD perspective, the country of destination that are trying to promulgate these changes, they want to try and get that message out to all of the countries that are importing into New Zealand in this case. So really they will provide whatever information, guidance. So there's some really legitimate questions that have been raised, but IRD, if they haven't already covered that in their fact sheets, they'd be happy to talk through those to make sure that it's understood, I guess. Yeah. And it is coming, as I mentioned, Norway from early next year. I've been having some conversations as recently as this week with the UK, with a vendor collect model. Singapore are looking into it as well. So now that the Aussies have kind of been the guinea pig and it's working and proving that it's working, then I think my take on this is that more countries, tax administrations around the world will probably move to this. So it's in people's best interest to at least understand how this all works.
With the fact, obviously, we've had it for over a year now in Australia. From a DHL perspective, there's been inbound individual consignments coming into Australia. Have we seen that number stay the same, increase off the back of the changes the government made?
Volumes have increased, so yeah, there's no decline in, which was put forward as a potential downside. The other one too is with the bricks and mortar retailers and this goes to I guess a wider issue, but the bricks and mortar retailers that are having to evolve. They can't really just be just that shop front anymore, really, or they can, but it's often to their peril. So the ones that I've seen working, and you would see this a lot as well, is that the ones that can actually have a presence, but also have an online presence, that mix, if they can get that mix right, and that's really what a lot of these changes to the low value goods talks to. It's just about having tax neutrality, whether it is a brick and mortar walk-in a high street shop, or whether it's someone on their device on the train on the way home from work buying that pair of shoes. The same GST will apply across the board. That's what's really the guts of it.
Yeah. A great question from Damien here. What happens when goods are returned to Australia for a refund that have had GST collected on them at the point of sale in Australia?
Sorry, can you say that again? So
a customer in New Zealand has received their goods in New Zealand, they've paid the GST at the point of sale, and now they're returning the goods back to the Australian retailer for any number of reasons. What happens to that GST that they've paid? I guess the question is probably, can the consumer claim the GST back?
Yeah, look, at the outset, I would recommend they talk to the IRD. But one thing with returns, and that's come up a lot, is the advantage of having a registration number with the ATO, or in this case the IRD, is that those returns that are made quarterly, there can be adjustments made. So if there are returns that are made, they can be factored in. I certainly know that from the ATO perspective. Don't quote me on that from IRD, but I imagine it would be similar, that you've got that relationship so that if there are returns, they can be factored in to that. So once it's in place, it's being collected, returns will happen. That's a reality of it. And it has been factored into this scheme, but it's really between the relationship between the registrant and the IRD. They'll need to just work through how to report that.
Yeah, okay. Question from Marcus. Can I charge GST on all transactions as standard as I have goods above and below $1,000?
Yes, you can. Yeah, there's certain criteria that need to be met, which are on the IRD website, but it's not a case of, and that's for good practical reasoning. I mean, that people will have both, and shopping carts are tending to get bigger and more high value. So if it does flow over there, that's fine. You don't need to have two separate systems, because that then puts an impost on business. So we're trying to avoid that.
Yeah. Okay. Another interesting one from AJ. So we are an Australian company shipping direct from our supplier in the US to New Zealand businesses. How would we determine the GST in this scenario? So, Megan,
So if you're shipping to a New Zealand business, it's a B2B transaction, so it's therefore exempt from the. I think, again, in that particular scenario, it'd be worth checking that out within main revenue just to make sure you are compliant.
Yeah. Another part to this question may be we have a number of customers who, not just Australian customers, but DHL customers around the world who will obviously be selling to New Zealand consumers. So this is not centric to just Australia to New Zealand.
That's right.
This is all retailers all over the world sending into New Zealand.
Correct.
So,
yeah, and that's a good point, Mike, because a lot of those big e-tailers in Europe and the US and so on have already got their heads around this vendor collect model into Australia. So into the New Zealand market, they should be well versed at really just changing that destination. The concept is the same, the number, quoting them through and collecting a point of sale. It's just the destination that, and really there's a very good fact sheet on the IRD website which compares if you're selling shipping into Australia and into New Zealand and low value goods. There's a very good comparison about what's very similar and what slight variances there are.
Trade Me, a very large, prominent New Zealand marketplace. Back to that sort of question. A seller who's selling on Trade Me. The responsibility of the collection of GST, the owner of the goods, I suppose, on Trade Me or Trade Me themselves? What's the advice there?
I think check that with Trade Me and within main revenue, because obviously Trade Me is a huge marketplace in New Zealand, and customers are very used to buying goods from there, including GST. So I think just double check that scenario with IRD.
Okay. Yeah, and it depends on who that importer of record is too, whether they are a consolidation house. The redeliverers one is an interesting one. That's effectively very popular in the US, where very low value goods from multiple domestic suppliers will be consolidated into one shipment and then sent. And there has been a lot of GST leakage around that. So those three main categories are worth checking out to make sure that you understand.
Cool. Fantastic. Well, look, we're fast running out of time. So there's obviously a lot of question and a lot of things that will play out over the ensuing weeks as we get closer to the 1st of December. So certainly from a DHL perspective, we'll share the information, the IRD websites where you can go to get further advice. We also stress, for those of you who do have a DHL Express account manager already, get in touch with them, start that conversation around how you're going to pass the number through to us so we can ensure that you're compliant and that you're ticking that box. And similarly, if you don't have a DHL Express account manager already, then we will be putting out details of a colleague of ours, Barton, who you can get in contact with as an additional support to start filtering those questions and guide you in the right direction to support with that process. So beyond that, thank you both to Megan and to Ben for your time today and sharing the insights that have happened so far and what's going to be coming in the future. And to all of you as well, thank you for your time and joining. There will be the slide deck shared, as we've said, and similarly, if you just want to hold on to the call for a minute or so, there'll be a quick questionnaire just to evaluate some of the understanding of what's been shared as well. So otherwise, wish you all a nice day and we'll speak to you soon.